Us live from the Chicago Board Options Exchange is Steve Quirk of TD Ameritrade. Steve trades everything from currencies to commodities. Also joining us here in the studio is Joe Saluzzi, who co-manages trading at brokerage Themis Trading. He's been bearish on stocks for most of this year because of the weak economy and concerns about European sovereign debt. We were just talking about that, and we're going to focus on that actually in this program today. Joe, you're still concerned about that? You don't feel like tightening spreads signal bond investors are sanguine at the prospect of European banks failing?
I don't think the spreads are really tightening that much. You still see them starting to widen out. They'll tighten a little. That could happen at any point. We never know when a sovereign, debt crisis is going to pop up, and that's one of my main concerns about this type of stock market that we're in. It's very complacent now. Again, you see the VIX going much lower. There's that attitude, and I don't know if you guys saw the David Tepper interview the other day, where hey, we've got the Fed backstop. Don't worry, guys. It's going to go higher. Even if things are really bad, you don't have to worry. And there's a lot of credibility there, and you have to respect that argument, right, because there is a Fed backstop.
What about the argument, Joe, that no matter what happens right now, either the government or the Fed is going to do something to prevent another collapse here, and so that is kind of bullish for the overall market environment? For
the stock market, that's what's holding it up. But when we always come in and we talk about the economy versus the stock market. Mm-hmm. When we look at the real economy, probably things have gotten worse since I've been here last. They're not getting any better, and we can point to all the data points. But the stock market, again, is seeing that Fed backstop, and it's saying, okay, we got cheap money out there. And then the other argument, which this guy Russell Napier out of CLSA, which he makes a good argument as well. Hey, all that money the companies have on their balance sheets, they got to spend it. M&A, corporate buybacks, rising dividends, all good arguments for higher stock prices.
Right.
But in the end, what makes a stock go up? Profits, okay? And you can't make profits when the economy's not growing. I don't care how much you want to devalue the dollar, you eventually have to have some demand coming into the system. And that's more of a longer-term argument. So will I fight the tape here and say, no, we can't go higher? No, I'm not going to fight the tape. I still think we're range-bound. I think this is the upper end of the range, and I wouldn't want to be a buyer right now. Probably back to 1050 again, 1150, 1050. But the downside risk, I think, is now much greater because you have sovereign issues. You have geopolitical issues. Suppose the Fed doesn't do the QE2 that everyone's looking for. Then what?
By the way, when he says much greater, he means much greater.
Much greater. He does indeed. To our guests, we've got Joe Saluzzi in studio and Steve Quirk out there at TD Ameritrade. Steve, let's bring you into this conversation. So what do you make of the last few months here? We had a good month in July, not so great in August. Great month, best September since, I think, 1939 here. It looks like September's wrapping up to be just a chaotic market. Doesn't make any sense?
Well, I think Joe is correct in that we still really have not broken out of this range. We're still range bound. We're just on the top end of that range, and I attribute it to exactly what he described. That whether there is a great deal of liquidity or not, the perception is there, and that's why you're seeing gold at the level it's at. And the dollar at an 8-month low. And until we see something significant that's going to get us out of the top end of this range, I would feel much more comfortable on the short side than on the long side at this level, because playing this range has worked, quite frankly, for the better part of this year.
Hey, Joe, it's Adam. Let me jump in. You see a ton of hedge fund flow. Where do you see guys consistently making trades that make money?
Good question. Go ask some of those quant guys who keep closing up funds right now. Hey, they have different strategies. We're agency traders, so our job is to trade and get best execution. So it's not my job to pick their stocks. And there are guys who are, long-term holders, and they've seen stocks drop to a value that they really like sometimes, and they're loading up, and they're, 5-year holders. But then there are other guys who are short-term, news event-driven guys who are going to short stocks here and so on. So we get them, Adam, we get them all different types.
You can't give me one particular area. Guys aren't coming back and saying, I'm playing the banks in a range. I'm playing the trades for more.
I do have some sort of anonymity and client confidentiality, unfortunately.
All right.
Let me just point out, when I say way on the downside, you think that ultimately the S&P could go to 500.
Well, from the last
that's almost like David Tice bearish.
I'm not going to come in looking for a headline like Prechter did the other day, right? Could
the other day or 20 years ago?
He's
would have made a difference?
That's the perma bears are always wrong, right? But I don't want to get into that bearish argument today, but it could happen again because we saw it happen on the flash crash. We saw it happen back in 09.
Though.
It could, under an extreme event. Would you be a buyer down there? Of course. Why? What is my main problem right now? I'll give you 2 quick points. Money keeps coming out of the market. Another one today. $3 billion more last week came out of the equity market. Okay, there's domestic equities. That's almost $70 billion since the flash crash on May 6th. Nobody believes in this market. There's no confidence. Secondly, a great point, Zara was just talking about the IPO market. It is basically dead. They're trying to revive it, okay? Liberty Mutual is a great example of no demand. The demand that you see on a daily basis is just fleeting, short-term. Guys buying Citibank at $3.80 and selling at $3.80 at the same price, so they collect liquidity rebates on both sides.
But with all that money on the
no
side,
sense.
as soon as the tone starts to change and the consumer confidence, the consumer sentiment, the investor sentiment, that's a lot of money that can potentially come back.
The money is sitting on the corporate balance sheets. I don't believe the money is sitting in the consumers and some of the hedge funds and mutual funds. There was a report today saying there's only 3.5% of cash in these mutual funds. That's not a lot of money to invest. They're in there all in right now.
But what about all the money in
corporate
bond
cash is a
funds?
different story. Well, they could shift over to equities, but you need confidence, right? What is the equity market all about? Right now, it's about a casino and no one trusted after May 6th and all of the craziness that goes on. You need to fix that, first of all. But secondly, you need to have public perception of growing earnings, corporations, and they know. The public, you cannot lie to the public. Everybody knows the unemployment is still high. Everybody knows that their neighbors are having problems or they may self to having problems. And no matter what the NBER says, the recession is not over.
Hey, Steve, I want to bring you into this discussion because we've talked about stocks so much here. I was having drinks a couple of nights ago with a few retirees or pensioners out there, right?
Yes.
And they said these policies that this administration, the Federal Reserve, are putting out there are absolutely killing them right now. They cannot make any money in the market right now, owning bonds, at least for 10 years at 2.5%. Is this going to happen for the time being, or is it going to go in the future like this? Are we going to see low rates for quite some time here?
Well, the anticipation keeps, they keep pushing the forecast out as to when you'll see something in the way of the opposite of QE. In other words, when we'll start to see rates blip a little higher. They have blipped higher, by the way, in a couple other countries. So there is some growth going on. Just isn't growing. It just isn't happening here. But the anticipation, and you can see it in the financials. If you look at the financials, the anticipation is that we're going to continue to have a very tough environment from an interest rate standpoint, and it's reflected in our trading volumes.
All right, everybody, I want to just take you to a quick live shot here because the China House currency bill, that debate getting underway. Democratic Congressman Sandra Levin, as you can see, beginning that debate process. This is expected to last about an hour or so with potentially final passage coming after 5 p.m. Eastern. But again, we want to keep tracking that. One of our big stories of the day. Again, that's Congressman Sandra Levin. They're beginning that debate on that House Chinese currency bill. Joe, you're shaking your head. Why?
It's so reactionary, and what would you expect from a politician?
What do you think? Are you saying this is a populist move?
Let's blame China
Elections
for our problems. Let's cause a trade war. Let's devalue our currency because we can't grow our own economy, and let's have the Fed keep rates at zero. Why don't we fix the real problems? Why don't we look at our own economy and our own issues? Do we need, do we have some, real problems in manufacturing, things that we used to do so well we don't do anymore? Forget blaming other people. They did it in the 30s, smoot-hawley, okay? It lasted forever. Don't go that way.
I actually, you know what? A couple of things I got from a guy that writes into us a lot, DJ Adam. He writes into Adam. I don't know, Carol, if you talk to him, but one of the things he says, we need to get really good high-wage paying jobs back in this economy, which you have to agree with, right?
Right.
So what kind of jobs is this? I mean, is everybody going to become a doctor? Is everybody going to be, a Wall Street trader? I mean, the manufacturing jobs aren't going to be those good high-wage paying jobs anymore, are they?
Right,
and if they are, you're going to have to pay $7,000 for an iPod.
Well, if that's what it is. But that's exactly right. Maybe we need to retool and retrain and do things differently because the world has changed. And maybe we're still doing it the old way, thinking that everyone's going to buy our stuff. It's not the case anymore. This is a much longer-term issue. If you can't get that unemployment rate down, I don't have the answers. I don't know what the next job is going to be.
Right.
But that's the real issue. That's what we really have to address.
Hey, Joe, when you talk about the, politicians maybe playing for the populist vote here by trying to pass this China measure, and you talk about what they should be focusing on, I mean, what's your answer? What should they be doing? What can government be doing in this kind of situation?
Nothing. Step away, okay? Step away. You've already done too much. Anytime they jump in, they damage it anyway. Stop the spending. Stop spending money you don't have. Be more efficient if you're going to be spending it. All the fraud, all the entitlements that are going on. Hey, look at this stuff, and you really got to kind of tighten your belt a little instead of just
like
throwing
everybody
more.
else has had to do.
Exactly. If we're all we run our own businesses, we're consumers in their own household. They run their own business. Tighten up.
There's no government, Joe, like no government.
Did we not talk flash trading with you?
We didn't.
Let's talk. That's why I thought I came on here for.
Joe, a pleasure to have you on. Joe Saluzzi. Thanks to Steve Quirk as well. Quick break. We're back in 2.